Most people think the first thing they would do if a global crisis started tomorrow is check on their family. But let's be honest, a lot of people would reach for something else first: their brokerage app. Not because they're greedy, not because they're reckless, because financial anxiety does something strange to the brain. It takes every instinct about survival and quietly redirects it toward a number on a screen. And that's where today's story begins, because Toni just woke up to a headline that feels bigger than usual. Markets are red, news alerts are everywhere, every financial channel is talking about global uncertainty, and Toni's finger is hovering over the sell button. This is the moment most people rush. So before you make a move, think twice, Toni. Here's something that might surprise you. When geopolitical tensions rise, the people rooting hardest for you to panic usually aren't foreign governments. They aren't hedge funds. They're the financial media. Not because of a conspiracy, because of a business model. When fear increases, viewership increases. When viewership increases, advertising revenue increases. And the longer you watch, the more profitable your anxiety becomes. So when markets drop 2% and the headline says global markets in free fall, something important is happening behind the scenes. A 2% drop is normal. It happens dozens of times in an average year. But moderate pullback consistent with historical conflict patterns doesn't get clicks. Free fall does. The financial news ecosystem has learned something very simple about human psychology. Fear keeps people watching. And when you're scared, you're more likely to make quick decisions, sometimes very expensive ones. Let's go back to Toni for a moment. Imagine two people waking up to the same crisis headline. Toni represents the first one. He watches financial news for 3 straight hours. Every expert sounds worried. Every chart looks dramatic. By 9 a.m., Toni feels something that seems like clarity. This is bad, he thinks. I should sell before things get worse. So he does. Portfolio sold, cash secured, problem solved. At least, that's what it feels like in the moment. Now imagine someone else. Let's call her Sarah. Sarah sees the same news alerts, but instead of watching the coverage all morning, she remembers something simple. Markets have lived through a lot. 2 world wars, a nuclear standoff, multiple recessions, a global pandemic. And after every major crisis, eventually, the market kept climbing. That doesn't mean markets never fall. They absolutely do. But history shows something interesting. They rarely stayed down because of war. Here's a fact the financial media rarely leads with. Across more than a century of data, stock markets don't usually collapse during wartime. They dip, they panic for a while, then they recover. During World War II, the Dow Jones rose roughly 50%. During the Korean War, it gained around 60%. During the Vietnam era, it climbed again. Since 1945, the S&P 500 has delivered positive 1-year returns after the majority of major armed conflicts, which sounds counterintuitive until you understand the economics of war. Wars are incredibly expensive. Governments spend enormous amounts of money on logistics, manufacturing, infrastructure, energy, and technology. Weapon systems, fuel supply chains, communications networks, medical equipment, and much of that spending flows directly into companies. In other words, governments become some of the largest customers in the world overnight. And when large customers spend aggressively, corporate revenues eventually reflect it. That doesn't make war good, but it explains why markets behave differently than people expect. Back to Toni. After watching the news all morning, he sells his index funds. He feels relieved. Doing something feels better than doing nothing. But there's a hidden problem. Market crashes and market recoveries tend to happen very close together. In fact, some of the best trading days in history happen within weeks of the worst ones. Miss just a handful of those recovery days, and long-term returns drop dramatically. Researchers at J.P. Morgan found something striking. A $10,000 investment left untouched in the S&P 500 over nearly 20 years could grow to around $70,000. Miss only the 10 best trading days in that entire period, and the ending value drops by more than half. 10 days out of thousands. That's how sensitive long-term investing can be to timing mistakes. Meanwhile, Sarah did something that looked almost boring. She didn't sell, she didn't rush to buy complicated strategies, she simply checked the structure she had already built. Because smart investing during uncertain times isn't about predicting headlines, it's about having a system that works even when headlines are loud. And that system begins with something very simple. First, the cash foundation. Before worrying about investments, Sarah made sure she had enough liquidity to handle real-world disruptions. 6 months of living expenses in a high-yield savings account or money market fund, and a small amount of physical cash at home. Not because the world is ending, but because digital systems occasionally fail during crises. Cyber attacks, banking disruptions, or temporary outages can happen. A little physical cash isn't paranoia, it's redundancy. Once that foundation is built, the goal is not to sit in cash forever, because wars historically bring something else with them: inflation. Governments often borrow and spend aggressively during conflict. That spending increases the supply of money in the system. And when inflation rises, idle cash slowly loses purchasing power. Which is why Sarah limited her emergency buffer and kept the rest of her investments working. She maintained exposure to diversified index funds. Broad market funds like total market or S&P style ETFs remained untouched, because historically, broad markets have proven remarkably resilient. The economy adapts, companies adjust, growth eventually returns. But Sarah also added balance, not by guessing the future, by acknowledging patterns that have appeared in previous crises. Certain sectors tend to perform differently during periods of geopolitical tension. Energy markets react when supply chains tighten. Defense industries often receive long-term government contracts. Consumer staples, things like food, household goods, and everyday products, continue selling regardless of headlines. People may cancel vacations. They rarely stop buying groceries or basic necessities. These sectors don't make exciting headlines, but stability often hides in unexciting places. Sarah also thought about inflation protection, because one surprising historical lesson is that traditional long-term government bonds sometimes perform poorly during wartime inflation. When governments issue large amounts of new debt to fund spending, inflation can erode the real value of fixed payments. So instead of relying only on traditional bonds, investors often consider inflation-protected instruments. Treasury inflation-protected securities, for example, adjust with inflation over time. They aren't flashy, but they help maintain purchasing power. Again, none of this requires predicting the exact future. It simply acknowledges that different assets respond differently to economic conditions. Diversification is less about guessing and more about preparing. Now let's return to Toni. After selling his investments, he sits in cash waiting for clarity. But clarity rarely arrives when people expect it. Markets begin recovering quietly. Energy prices move. Defense contracts expand. Consumer staples remain steady. Months pass before Toni feels comfortable re-entering the market. By then, a large part of the rebound has already happened, and the opportunity that felt dangerous earlier now feels obvious. Meanwhile, Sarah continued her normal routine. Automatic contributions kept running. Her diversified portfolio stayed intact. She didn't try to predict the bottom, she simply stayed invested. Over time, the difference between these two approaches grows, not because Sarah made a brilliant prediction, but because she avoided a costly emotional decision. That's the quiet truth behind most investing success. It rarely comes from one perfect trade. It usually comes from not interrupting compounding. Markets rise, markets fall, news cycles repeat, but long-term growth rewards patience far more than reaction. So when the next crisis headline appears, and eventually one will, Toni will face the same moment again. Phone buzzing, markets red, experts arguing on television, and the temptation to act immediately will return. But this time, Toni pauses, He remembers that panic often arrives before information. He remembers that markets have survived far worse headlines. And he remembers that reacting emotionally is often the most expensive move in finance. So he puts the phone down, makes coffee, and lets the system he built do its job. Because sometimes the smartest financial decision is simply refusing to panic. Think twice, Toni.